Okay, so Math at Work 11, this is your lesson on borrowing money. Again, this time focusing on different options when it comes to certain loans. Okay. All right, so a couple of different types of loans we can talk about besides credit cards, which is what we focused on last lesson. Big reasons people end up getting loans would be to buy a car, so they have a specific car loan. You get a loan to buy a house, which is specifically called a mortgage. You can get specific lines of credit. You can have specific store loans, and then there's things called payday loans, right? And we'll talk a little bit about each of these. So those first two that we talked about with car loans and mortgages, these are considered insured loans, okay? The reason they're considered insured is because there's an object that's worth money tied to the loan, right? The loan was for a specific object, and that object will continue to retain value over the course of the loan, okay? So in the loan agreement that would happen here when you get a car or you buy a house, if your loans become in default, right, which means you're not making your payments, right, after a period of time, the bank or whatever organization lent you the money will eventually come in, and this is where you kind of get this idea of repossession, because if you haven't paid back the loan, they can then take back the object that's worth value and then sell it themselves, try and recoup the money that you owe them for their loan. Okay. When we talk about insured loans, we talk about the time it's going to take you to pay off that loan, and that's called the amortization period. Okay, so whenever you first get a loan, they kind of give you a typed out spreadsheet that kind of shows you, okay, this is the date every payment's going to be made, and it'll show you how long until your entire loan is paid off, right? And depending on whether you're making monthly payments or biweekly payments, it'll change your amortization period. Okay. Another thing when it comes to loans is about the idea of having a down payment. And again, this is really big when it comes to the idea of those insured loans like car payments and mortgages. Okay, so when we talk about a down payment, it's a lump sum of money that's paid up front by a buyer to help offset the cost of an item. Okay, so basically if you're buying something that's relatively large, right, for a large sum of money, you want to be able to have a decent amount of down payment, so it gives the loan insurers a little bit of confidence that yeah, you are capable of getting money and can come up with some, okay, like they're saving it beforehand. Not to mention the larger down payment you have, the less you actually have to borrow, right? So I mean that's going to help because then that's less interest you're going to pay on the loan. Now there's certain purchases that actually require a down payment, right? So a big one being the purchase of a home, right? In Nova Scotia right now, you need to have a minimum of 5% of the value of the purchase price of the home in order to be able to actually get the mortgage for the remaining 95%, okay? And that's like a minimum amount, okay? So down payments are big deals, especially when it comes to purchasing a home, right? And even when it comes to things like when you're renting an apartment, they want not necessarily a down payment, but they either want a half month's rent damage deposit, right? So again, it's kind of ensuring that they're going to get some money if there's damage being done, right? Or even if you're first and last month's rent, so that they can again see that yes, you are capable of coming up with the money. Okay. Not all car loans require you to have a down payment, right? Sometimes you'll hear those promotions that they have like no money down, and like don't pay for 3 months kind of thing, right? And that offer will allow you to purchase items without that down payment. But again, keep in mind that might be kind of just a ploy to pull you in to get you to pay for that new vehicle or to buy that new vehicle, because if you're going to put no down payment on there, while that's great that you don't have to come up with a down payment, it's still not that awesome because it means you're going to be spending more money because your loan is needing to be for a larger amount, and then therefore you're going to pay more interest on it. Okay. When we talk about lines of credit, they're a little bit different. Okay, so a line of credit is typically offered through a bank or some sort of banking institution and allows you to borrow money as needed up to a pre-approved amount, right? So you have to apply for a line of credit similar to how you have to apply for a credit card, and there's a maximum amount that they'd be willing to loan you, okay? Now you would typically use it similar to a credit card, okay, but it would be an example as an unsecured loan, right? Because you're just using the money for whatever. You could be using that line of credit for repairs. You could be using it for maybe a trip or something. You're using it for emergency vet bills, right? Something that you wouldn't necessarily be able to get the money back from, right? So there's nothing that you can then sell that's associated with that specific purchase, okay? So it's considered an unsecured loan. Again, like I said, you do end up having to have an application be approved for a line of credit, and you do require proof of income, okay? And again, they're very similar to credit cards because they have similar interest rates and minimum monthly payment amounts that you need to pay on them, okay? The big difference, actually it's very similar again with a credit card as well, is that once your credit you can pay off a line of credit, but then it's still available and can keep continuing to be used. That's similar to credit cards. It's not the same as a car loan or a mortgage, right? When you have that secured debt, once you make your payments on your car loan or your mortgage, once they're all paid, you now own that thing. Nobody can come take it from you anymore, and you don't pay the loans anymore, right? But you don't have access to more of that money, right? So, but with a line of credit, you might have a $5,000 line of credit, you spend it, you then pay it off. Once you pay it off, it's still available for you to then access, okay? One difference would be maybe in a student line of credit. If you're getting a line of credit that's maybe specific for like tuition or something like that, it would be something where once you've paid it off, they don't allow you to keep accessing it because you're done with your tuition, okay? Something else that's kind of in there too is the idea of overdraft protection, right? This is actually a type of loan as well that's offered by certain banks to qualifying customers. And if you have overdraft protection, it basically allows you to withdraw more money from an account that you actually have in it up to a certain approved amount, okay? So the idea behind the overdraft protection is that, you know, if you've got car payments coming out, you've got rent coming out, if you're a little bit short, you don't want to get dinged from your bank with $45 non-sufficient fund fee plus a $45 non-sufficient fund fee from your car payment place or your place where you're renting, right? So it could cost you more. But if you have this overdraft and allows you to go maybe minus $100, then or you have an emergency, you need to get access to that, right? That can be a benefit of overdraft. However, it is kind of like a personal loan from the bank. So again, if you're not back to zero by the end of like the month, they're going to charge you interest on how much you're over and for how long you've been over, right? And again, there's typically a higher banking fee, like your monthly fee might be higher if you have this type of banking in the overdraft protection. Okay, so just kind of go back. I want to make sure I've hit all those things, right? So we talked about car loans, mortgage loans, store loans. Really the only thing to say with store loans is that places like Leon's, right, where you're going to buy furniture, you might be able to get a specific Leon's credit, right? But that would be, it's even still financed through a different organization, right? But again, it's this idea of, okay, well, I've purchased this particular item, and depending on the agreement, it might be a secured loan or not, right? But it's going to they're very, very different depending on the store. But going into payday loans. So payday loans are advertised as emergency loans for a particular amount, and you just need to have some sort of proof of income, right? So typically you've kind of seen them as like you need your money now, but your payday's not till next week. Come here, show us that here's my last 3 pay stubs of this amount. We'll give you your paycheck from us instead, and you just have to pay us X number of dollars for us giving you the service, right? And some people think that's, maybe that works, right, if they're desperate. But the thing is that payday loans have notoriously high interest rates, right, up to 30%, and some even higher than that, okay? And typically they're not a good idea for a healthy financial future, right? Because what's going to happen is you're going to be charged money, and quite a bit of money, for the money that you were going to be getting anyway. And then all of a sudden, that's an extra payment that, when you do actually get your paycheck, right, you're going to have to use that entire paycheck to pay off that loan. And then some people kind of get in this habit of, oh, well, I don't have to pay it off right now. I do have the option to pay it back slowly, and then all of a sudden you get stuck into it, and then as more days go by, you're getting charged more and more interest, okay? It's actually a pretty important thing to know about. So the following link here is a video that I want you to watch, right? So it's about a 20-minute video on its own, and in your next assignment that you're submitting, there will be some questions in there specific to this particular video. Okay, so you do need to watch that. I'll post the link separately in Google Classroom as well, but it is there in this set of slides. Okay. So the big thing to kind of do next is just to kind of look at that work that we've been doing with compound and simple interest and trying to calculate the interest that's paid on a particular loan, okay? So again, it's all going to depend on the agreement of the loan itself, right? And the terms of the loan, what percentage it is, if it's compound or simple, how long the agreement's for, etc., okay? And the thing you need to know as well is that whenever you make a payment on a loan, part of your payment goes towards the interest and part of your payment goes to actually paying off the loan, right? Because if it's got interest associated with it, you're not just, every time you make a $300 payment, that doesn't mean that you now owe $300 less. It's because some of that money went to pay interest instead. So it doesn't always equate. And typically what happens is that the interest is paid up front. So in the first maybe couple years of your car loan, you kind of feel like, man, I don't see this principal going down very much. It's going down, but not a whole lot. It's going to take me forever to pay this off. But then in those last couple years of a loan, the interest payments of your own personal payment coming into your bank account are less, so it does start going a little bit faster. Okay, so let's kind of look at an example here. So let's say that Larry borrowed $12,000 at 5% interest compounded monthly, and he negotiated regular loan payments of $350 at the end of each month until the loan is paid off. How much of Larry's first payment will be interest, and how much will be principal? All right, so let's take a look at how we would actually solve this on the board here. Okay, so when we calculate interest, right, we need to think about what the interest rate is, what the principal amount, and then how much is being compounded, right? And this was, again, a monthly payment. So Larry has borrowed $12,000, right? And we need to multiply that by the interest rate, which was the 0.05, but because he's making monthly payments, we're dividing that by 12 to figure out what it is in a month, okay? So if we take that principal amount, we multiply it by the percentage, but divide it by 12 because of the 12 months in a year, we get a value of $50, okay? So Larry's making this $350 payment, but out of that payment, $50 is going just to paying the interest, which means if we do $350 minus $50, $300 is going to paying off the principal of the loan. Okay? So again, you're seeing that yes, you're paying $350, but $350 is not coming off the loan, only $300 is, right? Because that first $50 was in interest. Okay? The second part of this question is do the same calculation for the next payment. Are the amounts the same, and what patterns do you notice? So again, if we go back to this first, so this was all part A. If we go into part B, right? Well, since $300 is going to come off that loan, our new principal amount is $300 less, which is $11,700. So now the interest being calculated for this next month is on the $11,700. So I can take my $11,700, multiply it by the 0.05 divided by 12, right? Because again, it's monthly payments. And when I do that calculation, I get a value of $48.75. Right? So again, in that second $350 payment, $48.75 is going to go towards paying the interest on the loan. And then if we did $350 minus that interest payment of $48.75, we get a value of $301.25. And that's what's going off the principal of the loan. Okay? So what I want you to notice here is that as the months go on, the interest that you're paying goes down a little bit, whereas the principal, what's coming off the loan, goes up. Okay? And what I'll show you here, right, so there's your answers for those first two, but what I'll show you on this slide here is this is basically just showing if we kept going in this scenario, right? I'm not going to be asking you to do this, but this is what essentially an amortization table looks like, right? It's showing you each payment, right? In each payment, how much of that payment is interest, how much of it's coming off the principal, and then what do you actually owe on your loan at the end, right? So we've kind of done this for the first two, right? Seeing those values of 50, 300, and 48.75, 301.25, and you can keep repeating that, right? Because then from that 11,700, you can subtract that principal, and then you get this new value, and then from that value, that's how you calculate the interest and the principal, and you would keep going and going and going, right? There's actual, computer programs that will do this for you. You don't have to do it all by hand for, 60 payments or whatever, right? But just looking at it, you can see here that the payments are remaining the same. The amount of each of the payment and interest is slowly going down, while the amount coming off the principal is slowly going up. Okay? All right, so here's our next example looking at loans. All right, so Kevin borrowed $27,000 from his bank to buy a new car. He negotiated the interest rate of 6.5% compounded monthly. Kevin also negotiated for a longer payback period, and he will make monthly payments of $528.29 for the next 5 years. How many payments will Kevin make is the first part of our question. So basically, start with that one. Well, if you're going to be making monthly payments, there's 12 months in a year, you're going to do that for 5 years. 12 times 6, or 12 times 5 is going to be 60. Right? So for that first one, right, in A, he's going 5 years, and there's 12 months in a year. He's making monthly payments, so he will be making 60 payments. Okay, so over the course of the loan, he'll be making 60 payments. The next part of that question is asking, what's the total amount that Kevin will repay the bank, right? So we know he's only borrowing $27,000, but he's making 60 payments, right, of $528.29 a month. So what we can do is figure out, well, what's he going to pay back total, right? $528.29 every month for 60 months. And if we do that calculation, we get a value of $31,697.40. Okay, so even though he's only borrowed like the $27,000, right? He's going to actually be paying back $31,000. Okay, which then helps us answer the next part of the question, part C, which is how much interest will he pay? So how much of what he pays back is actually going to be interest, right? So since we know how much he pays back, okay, $31,697.40, and we know how much he actually borrowed, which was the $27,000. If we subtract the two and we find the difference between them, that gives us the amount that he's going to pay in interest, which is $4,697.40. This is the interest that he's going to pay. Right? This number is also sometimes called the cost of borrowing, right? Because you're not just borrowing the money and paying back the money, it's costing you more money, right? Because ultimately, almost an extra $5,000 is coming out of your pocket for the convenience, or like, you know, that's the thank you for your service of loaning me this money, right? That idea of the interest, okay? Part D of this question is saying that the average car retains about 80% of its value each year. Estimate the value of Kevin's car after he is finished paying for it. So we're going to assume that that $27,000, he didn't have a down payment, and that's exactly what the price of the car was. So what we would do here is take that $27,000, and it's retaining 80% of its value, so we're going to multiply it by 0.8. Right? If we do that once, then that will tell us what the value of the car is after 1 year. But when he has it paid off, that's 5 years. So we need to multiply it by 0.8 5 times, right? So after 1 year, after 2 years, after 3 years, after 4 years, after 5 years, right? And if you kind of think back a little bit to me when you learned about exponents, if you have the same thing being multiplied by itself over and over and over again, that's when we use exponents. So what you could actually write here is you could rewrite it as 27,000 times 0.8 to the power of 5, because you're doing that 5 times. All right, and then you're doing that exponents first, right, the 0.8 to the power of 5, then multiplied by the 27,000, and you get a value of $8,847.36. Right? Basically saying, yep, this is how much the car would be worth, right? So even after you have it all paid off, right, you've got something that's worth about $9,000. So should you need to sell it, you might be able to get something close to that for it, and then use that as a down payment for a new vehicle, and maybe not have to borrow as much money or have as long of a loan. Okay, got options. Or you can just keep driving it until it drives no more. Okay, so that was our second example, kind of again looking at some loans there, your answers. We'll do one other final example here, just kind of looking at some loans here. So in this one, Mason is buying a new TV. The TV costs about $3,500 or $34.99.99 in the store. He only has $1,000 saved up to use as a down payment. He has the following payment options. Right, so option one is he can go to his bank, get a loan for 6.5% per year over 2 years, right? And we would kind of assume that that's compounded interest there. Okay, option two is the store actually has its own loan, kind of like layaway plan, where he can just pay the store the $50 down payment, keep his other remaining $950 and use it as payments later, right? And then do 12 monthly payments of $325. Option three is to go and take out a payday loan, in which you would actually be required to pay 1.12% daily simple interest, and you would have to repay the loan within 30 days, right? So 30 days is the most you'd be able to have the loan out for, right? So in terms of interest, it's only going to accrue for those 30 days because that's when you have to pay it back by, okay? What is Mason's best option in terms of his finances, right? So in terms of finances, we're really just strictly thinking about how much money is he going to spend versus how much is he going to save, okay? So while there might be other scenarios at play here that would make you want to pick one option over the other, right now we're going to look at it strictly from a financial perspective of which one saves him the most money. All right, so let's just kind of analyze each one of them. So if we look at the first one in terms of option one, okay? So in option one, he's getting that loan from his bank. First thing to realize is that, well, if he's already got $1,000 saved up, we're not borrowing the $3,500 from the bank, right? We're borrowing, so we would take that $34.99.99 and minus $1,000 there. So we're only borrowing $24.99, right? That's what we're asking from the bank for a loan, right? And now we're saying, all right, well, it's at the particular interest rate, so we want to figure out, well, how much is it going to cost me overall? So compound interest, so there's my principal of $24.99. This is what I'm initially borrowing. 1 plus the interest rate divided by the number of times per year it compounds, but it was compounded annually, so it would just be the 0.065 to the power of, so this would be number of times it compounds per year, which is 1, times the number of years, which was 2 years, so ultimately this would be a 2. Okay, so then again, you would do what's in your brackets first. So $24.99.99 times 1.065 squared, right? Then you do your exponents. Right? And I don't think I've actually written down what that value is, and don't have to use my phone, don't have my calculator on me right now. So 1.065 squared, so then that's being multiplied by 1.134225, and then finally I can take that and multiply it by that principal amount borrowed, which gives me a value of $2835.55. Okay, so this is a number to keep in mind on option one, right? Essentially the cost of his borrowing here is that $2835.55, okay? Because he's only borrowing this much, but he's gonna pay back a little bit more, right? So you could kind of compare all the interest amounts, right? Whoever's got the lowest interest amount there, right? So right now, this is one of the values. It's gonna cost a total of $2835.55. Now we look at option two. In option two, we are, again, in option two, we're actually just using the store. So we put down the $50, and then we have to do the payment plan of the 12 payments of $325, right? So let's figure out what that's going to cost us, though, right? We're going to do our 12 payments. So this is option two. we're going to do 12 payments at $325 a payment, which is going to cost us $3,900, but it was plus the $50 down payment. So really, our cost of the TV is going to be $3,950. Right? Now he already has $1,000 saved up, so we can take that right off. So in this case, he needs to come up with $2,950, right, to finish paying off the TV. And that's the way we want to look at it, is, okay, well, which option requires him to come up with the least amount of money over a period of time. Okay, so in option 2, he's got to come up with $2,950 within a 12-month period. With option 1, he needed to come up with less, so $2,835.55 in a 2-year period, right? And then we can take a look at option 3. And option 3 was the payday loan. Again, he's already got the $1,000 down payment, so all he's borrowing is that $24.99.99. That's what he's asking from the payday loan people. And that was done at simple interest. So we would be using that formula of A is equal to P plus PRT, right? That was the value for the interest, that PRT, right? So this cost of payback ultimately would be that initial $24.99 that you borrowed plus the interest, which is $24.99.99, multiplied by your interest rate, which was 1.2%, so it would be 0.012, and let's assume it takes us the full 30 days to get that money back, right, times 30 days, right? Because that, I know this is typically time in years, but this is a daily interest rate, so we multiply it by days here for it to all work out, okay? And when you do that, you end up getting a value of $3,399.99. Right? So again, if we kind of write the option 1 down again, just so we can kind of see them all, option 1 was the $2835.55. Right? So we can see here that option 1 is in fact the cheapest. Right? Option 2 is not so bad, right? But I would kind of almost go with option 1 for a couple of reasons. 1, it does involve having to pay back less interest, and 2, you have more time, right? You've got 2 years to come up with all of that money instead of just the 1 year in that, okay? But that's just a personal preference. You could argue a different point if you wanted to. Just back up your answer, okay? So again, there's all of your answers for that. So that's it for just kind of analyzing loans. It's still just kind of working with that idea of, okay, well, how much is interest are we paying, right? How can I calculate the interest, right? Sometimes it's with a formula. Sometimes it's just by thinking about, well, how much am I going to pay back versus how much did I borrow? The difference would be the interest, okay? So Google Classroom has a set of questions for you to look at when it comes to not analyzing credit cards, but analyzing loans, okay? Okay, and then again, I did the same thing with this one where I also posted the solutions so that as you're working through them, if you're feeling stuck, you can look at my solutions to see what I would have done, or if you did them and you're wondering if it's right, just check and see how you're doing. Okay, this is our last official lesson in the financial math unit, so I'll give you kind of a couple days to work through those practice questions, and then I'll be posting your final financial math assignment, which is on investing and borrowing money, right? So your first assignment that you had was on banking and budgeting, right? Then you had a couple mini assignments on simple and compound interest, and now you'll have a final assignment on investing and borrowing money. Okay, so that'll probably be posted Thursday, and then you'll have kind of a week to work through that before we start on our final unit for Math at Work 11.